Welcome to Macro Money. This is Ilya Spivak, head of global macro at tastylive. Starting this Monday with some technical difficulties as these things go. No audio, then no ability to speak. And thankfully now, here we are. And of course, the markets do lend themselves to that kind of day. It is pandemonium out there in the wake of the jobs numbers that we got from the U.S. last week. So let's go ahead and dive right in. We are going to have a look here at what all of this meant for markets. And then what we're going to do is kind of get a sense for, does it make sense? And what is the next thing that is likely to move the needle on this? As you'll see from the title, we are, of course, focused on the upcoming speaking engagements from Fed Chair Jerome Powell. CPI is later in the week. I'm sure we'll talk about that as well. We're going to have Chris join us at the end of the session for the second half to kind of unpack all of this further. What we want to do here is first see what it is that the markets are doing and try to get a sense for why they're doing it. Look at the price action, see what that's telling us. Then see if we can put a finger on whether this makes sense, whether what the markets are doing here is consistent with what we might surmise is going on, and whether it has capacity to be extended and extrapolated out, whether it seems to be supported by reality. And then, of course, we'll look at that Powell speech that's coming up in the next 24 hours and see if, number one, he has the capacity to move this situation, and whether moving it is something he would want to be doing. So what we should end up with is a sense for how much follow through the moves that we're seeing in the markets, most dramatically Friday and today, whether those moves have scope for continuation, or whether this is still a function of the beginning of the year and the markets trying to find their footing for where things are going. So first, let's set the stage. Last week, we saw what was essentially a story of two jobs reports. We begin with the ADP report that gave us a sense for how markets might react to what would then be the official non-farm payrolls and the broader employment report, because interestingly, it actually wasn't the payrolls number that was the most action-inducing, it seems. But first, we got the ADP number last Thursday, and you can see here the ADP number was better than expected. 235,000 jobs added against the 150,000 expected, and the response very sort of straightforward. Dollar higher. You can see that's the Invesco long dollar ETF there. Underlying is the Deutsche Bank USD index. Ticker on that is UUP. And then on the other side of that equation, S&P 500 ES futures, gold, GC futures, you can see those coming off. So very, very straightforward. We get a strong-ish jobs number from ADP. Again, this is not the official numbers. This is the pregame. And as I mentioned last week, they tend not to be a very good indicator of where the official numbers go one way or the other. Very inconsistent. Sometimes they're close, sometimes they're not. We'll see that here in just a moment. So this response suggested, okay, stronger U.S. economic data means scope for the Fed having rates higher for longer. That's not good for gold, which yields nothing. It's not good for risk because it portends a higher hurdle rate on investment, a more expensive cost of funding for longer, and of course, bolsters the US dollar largely on all of those same grounds. If the Fed is going to keep rates higher for longer, you would expect a stronger dollar. You would expect the return on dollar to remain elevated in relative terms for a longer period of time, so forth. Very, very straightforward. Then, of course, we get the official numbers. And it's a very different story. And here, really, the main takeaway is that the headline payrolls number was actually not particularly different from expectations. It was a little bit stronger than the expected, still down from the prior month. As you can see, it wasn't even so much of a deviation that it merited showing up on this chart. But the key thing really that the market seemed to jump on initially was that inflation wage number, the average hourly earnings. That came in at 4.6 versus 5% expected, and the prior number was actually revised down from 5.1 to 4.8. And so the overall takeaway seemed to be there is less sticky inflation here than the markets anticipated. And we've talked about this before. There's the two components of inflation that the Fed is looking at. The transitory part, that's more a function of mending supply chains, uneven global reopening after COVID lockdowns, and so forth. And then there's the sticky part. In some ways, that's deglobalization, but the more immediate aspect is wages. Wages negotiated against the backdrop of runaway inflation do not tend to then adjust back down as, let's say, shipping costs would when whatever shipping disruption is remedied, or let's say when geopolitical risk eases and the situation in Ukraine, as an example, is absorbed. So when we look at this, we get a number that's meaningfully lower than expected. The markets cheer that number. Shortly thereafter, we get the services ISM. Now, the service sector is far and away the largest employer in the U.S. and in most developed economies, even in most sort of higher level of development emerging economies. Let's call them kind of middle of the pack economies, richer emerging economies. The service sector is the dominant source of economic growth. What we saw here, and this was perhaps the biggest disconnect, the expectation was that the service sector was going to grow robustly. This ISM indicator is another one of these indicators with 50 as the center line, where 50 is neutral, above 50 is sector growth, below 50 is sector contraction. And the lower you go under 50, the faster the contraction. On the flip side, of course, the higher you go above 50, the faster the expansion. So not only did we not get a number that was akin to the kind of growth that the markets were expecting at 55, we actually got contraction in December. So the biggest engine of U.S. economic growth shrank last month. That's a huge thing. That significantly seemed to have inspired markets, perhaps even more so than the employment report. You can see here what we got in the wake of these announcements is a much weaker dollar, a much stronger S&P, much stronger gold. The takeaway seemingly that these numbers are worrying enough for economic growth in the U.S. that the Fed is going to back away. That the Fed is going to say, okay, uncle, Enough. We need to dial this back down. We need to step away from this kind of aggressive tightening, ostensibly is the message here, and we are not going to keep rates elevated for very long. We're going to move relatively quickly to begin to wind these rate hikes back. That's what this response seems to say. To put this in context, this is the daily change in the US dollar as of Friday. Obviously, today we're not quite settled yet. But this is as of Friday. And you can see on Friday, UUP was down 1.3%. That's the biggest decline in about almost 2 months, let's say. Going on 2 months. So what was it here that precipitated such an aggressive rethink? I mean, surely this is one set of numbers. Granted, it's the kind of set of numbers that ostensibly the market wanted to see. And so the response was emphatic. But if we look at what has actually changed, it may not be all that much at first glance. So a dramatic move. Now let's see if it feels justified. We still have relative stasis on June Fed funds expectations. So the place where rates were expected to peak this year, June, still right around that 5% level, give or take. If we extrapolate and look at the full curve, we can see still June is that moment. We're a little bit off the 5 mark on the current yield curve. So from now, 6 months forward, that's still about June. And we're still looking at a situation where the peak is right around 5%. Give or take 4 basis points. But as we look later into the outlook, in particular, 1 year out, 2 years out, 3 years out, the picture is starting to get significantly different. In fact, as we get 3 years out, you can see there is a shift here of close to 50 basis points. Now, in the grand scheme of the Fed's aggressive cycle here, that's not all that much. So here's that stasis in June. Here's the dramatic move, and ostensibly that's the justification. So you can see before 3 years out, we were looking just north of 3% on Fed funds. That's about in line with where the Fed is. The Fed is projecting 3.1 by then, as of December's summary of economic projections. So about there. But what the markets are looking at now is sub 3. So there's about a shift there for the entire Fed outlook by about 50 basis points as far as where we ultimately land. And so the question then becomes, does this make sense? Does it make sense that the markets now are looking for relatively brisk Fed policy adjustment after this tightening? Now let's take a look at the entire picture. We have the spread between 10-year and 2-year futures. That's the yield curve. That's the spread. Those are the micro 10-year and 2-year yield futures. The orange line is Fed funds futures. That's the spread between January and December of next year. F4 is January, Z4 is December. That's the policy path for next year. The green, not surprisingly, is the dollar. Again, we're looking at UUP as the benchmark. And then the purple is the 5-year U.S. break-even rate. So let's call that medium-term inflation expectations. Going into the turn of the year, what do we see? Rate cut expectations build for next year. That's the orange line going down. Yield curve inversion deepens. That's the blue line going down. Dollar is rising in response to what is ostensibly recession risk and risk aversion. That would be why the yield curve would invert more and deeper rate cuts would start to show up in the 2024 outlook. And inflation expectations actually head down. So even as Fed rate hike expectations for next year erode, inflation comes down, expected inflation. That seemingly warns that the markets expect a significant economic downturn. Now, we can call it recession. We cannot call it recession if we choose. That's entirely a semantics question as to whether you call something a recession or don't call it a recession. That comes down to what the National Bureau of Economic Research decides to call it. But certainly there seems to be some sort of a flagging of an economic downturn of significant breadth here that's emerging. And then just in the past several days, again, really in the wake of this jobs report, we can see a bit of a shift. So the yield curve has become a little bit less inverted. Still very inverted, but a little bit less. The policy path for 2024, a hair less dovish. Only a hair, but nevertheless. The dollar is dramatically lower. And for now, inflation expectations still down. Now, in an environment where this is the mix of influences, and granted, it's only a day or two, and the markets are still shaking off the holiday funk. So I wouldn't go so far as to say these are really well-established moves that are necessarily backed up by follow-through. We'll talk about what could happen here in just a moment. But this seems to be optimism about a soft landing. This seems to be the market essentially having gotten a round of really soft economic data, in particular that ISM number, but certainly weaker wages was a part of it, and concluding that the soft landing scenario where the Fed manages to land inflation without crushing the economy might actually have legs. That this could be where we are going. Again, very early to say, but if the yield curve is steepening, even amid ongoing inversion, if in relative terms it is steepening, rate cut expectations are coming off the board. Inflation expectations have not perked up in an aggressive way. We'll see how the 5-year settles today, but it doesn't seem like they're getting dislodged from where the Fed would want them to be at, give or take. Then this seems relatively Goldilocks. Not too hot, not too cold. Just about where the markets would want it. Certainly just about where the Fed would want it. But one issue here, of course, is that the Fed, and in particular Jay Powell himself, have been very resistant to calling victory here until it looks well established, until it looks like inflation expectations are really well and truly anchored where the Fed wants them. And here, we might have a bit of an issue. The green line is, again, UUP, our measure of the US dollar. The black one is the Chicago Fed's National Financial Conditions Index in the US. And this is very straightforward. When this index goes up, that means financial conditions are tightening. When it goes down, it means financial conditions are loosening. Not surprisingly, you can see here that with a weaker dollar, which is what we've had since October as we've had this recovery in risk, recovery in gold, we also get looser financial conditions. And looser financial conditions portend inflation. So this is exactly the opposite thing that the Fed would want to see. And in particular, Jay Powell, who has been very emphatic about the point that he wants to see inflation good and dead in the expectations, well anchored at 2% before declaring any kind of victory on this effort. And it's gone so far as to signal that if this is something that takes triggering a recession, then that's what's going to happen. So this move that we've seen since October, and most dramatically, of course, in the past 2 days of market action, is exactly not what the Fed ostensibly wants to see. They do not want to see a loosening of financial conditions that bring us back to around mid-year, as you can see on the black line. There, we're basically at the loosest setting for financial conditions that we've been at since about July. That does not seem like this is where the markets, in the Fed's mind, should be. They would like to see inflation continue to get squeezed by tightness. And of course, relative to the start of the tightening cycle, we are quite a bit more tight. But seeing a loosening of financial conditions is not what the Fed is ostensibly in the market for, which brings this upcoming Fed Powell speech into the frame. He's due to speak in Europe. It'll be a conference hosted by Norway's Riksbank, but the important thing is that he will have an opportunity to stand in front of a microphone and talk about these issues. Will this matter? Well, let's take a look here. This is news aggregation data courtesy of Bloomberg, and you can see here that the bars in the back are number of times in a given month that Powell, the actual name Powell, was mentioned in a news headline. And this isn't just Bloomberg headlines. This is an aggregate of the gajillion news sources that Bloomberg actually tracks. So we're talking about a tremendous amount of data here. So you can see that from about the middle of 2021, mentions of Powell in headlines, and we've just said Powell is relatively hawkish, and of course the middle of 2021 is exactly where this tightening cycle really started to find momentum. This is where the Fed began to signal that we're on the way. This is consistent with a rising dollar. In the back half of last year, it seems like Mr. Powell showed up less in the headlines. There was, of course, the official policy announcements, the official press conferences, but it seems like from Jackson Hole onward, he showed up in headlines less, which means he did relatively less of the kind of job boning at media events that you might expect. Not surprisingly, against that backdrop, a weaker dollar. Looking at it from the risk sentiment perspective, same bars, same news headlines count, now over the S&P. Again, as mentions of Mr. Powell in headlines come down, so too the S&P is able to find its feet. Dollar down, S&P up. What this means is, first of all, when Mr. Powell makes the headlines, he seems to be a hawkish influence. And number two, he hasn't really lit things up in a while. And given what we are looking at right here, and that ostensibly this is not what the Fed wants to see, we could have the opportunity here over these next 24 hours for him to come out swinging and drive some headlines and pour cold water on these markets, which could cut off follow through on these moves.